Also, the history of it is generally that whenever the state needs funds, especially more so than other times, they will go after demonized groups
Okay.
to try to get them. Um, the challenge here is that uh, energy companies made very little money the past decade,
Hmm.
especially the past 5 years. Let's use North America shale, for example. Um, Most of them were free cash flow negative during that period. They basically were producing, they were investing a lot and not making money for it. Now we didn't do reverse windfall taxes. We didn't give them money.
Yeah, of course.
But now, due to like this, the opposite happening, they said, okay, we're going to stop doing that. We're going to stop plowing money into unprofitable projects. Or we're going to be more capital disciplined. That's what our shareholders want. And so you get this spike in profitability. But that comes after a long stretch of unusually low profitability. And if you look at, say, stock indices, energy companies have been utterly terrible performers over, say, a 10-year period compared to broad equity indices. And now they're finally getting the spike, and then you come in and say, well, now you're the ones benefiting this. We're gonna take that away.
And take your money.
And so in the near term, you say, okay, it makes sense. So you take the chunk of that, you give it to people. The challenge is the downstream effects is, does that affect that company's decision to invest in more energy in your jurisdiction? Do they want to bring more energy to market, or do they want to maybe not put a lot of new capital in that industry because they say, okay, it's kind of like how if there's, say there's two developing countries, one of them is known for respecting property rights, and one of them every 10 years has a revolution and they take all the assets.
Okay.
If you're a foreign entity, then you have capital and you have expertise and you want to go, say, develop an oil field, you're going to pick the one that you have a high probability assessment that they're going to respect, that you own the assets and you
Hmm.
can profit from them. You're not going to put it in the one where you don't know the future of those assets. And so, for example, if there's like this tendency towards windfall taxes, the risk is that a company might say, well, if this is going to keep happening, maybe we should just not really keep investing in the energy space. Maybe we should go elsewhere. Maybe investors will say, even though a company might want to keep investing in the energy space, that's what they do. Outside investors might say, I'm not going to keep investing there because it's just going to keep getting windfalled. So I'll invest elsewhere. And so some of these things can be potentially short sighted, where the ultimate goal in the long run, the thing that actually fixes this, is to bring more supply online, and ideally the cleanest and longest lasting. So, in the near term, you just need more supply. Long term, you want the cleanest, best supply to come online. And of course, there's always efficiencies you can do. You can incentivize people to make their homes more energy efficient.
Hmm.
There's ways to reduce kind of arbitrary energy loss.
None of these things we've talked about seem to be solving the problem of the amount of debt in the system. Historically, with I've watched the Ray Dalio video on the short and long term debt cycle. Historically, how does the debt get removed from the system in the long term debt cycle? Is there like debt jubilees? Is there defaults? How does that tend to happen?
So historically, when debt as a share of the economy is this big, it defaults in one way or another.
Right.
It could be outright defaults. And that's common, for example, in a developed country where they owe dollars, they can't print dollars, and they just say we can't pay the debts. So
So that's
sorry.
probably what will happen in Sri Lanka.
Yeah.
Okay.
And then in developing countries, it generally happens instead through inflation, where they say
Developed.
developed countries.
Yeah, sorry, I
Yes.
thought you said developed.
Oh, developed countries,
Yeah.
where they say, okay, we're going to pay the debt. Because it's denominated in a currency we can print, so we're not going to default. But we're just going to print a lot of money, and we're going to pay those debts. So you're going to get every dollar or every euro or every pound you're owed.
Yeah, it's just going to be
It's
worthless.
just going to be worth maybe half as much as it was
Yeah.
when you bought that security. And so that's, I think, what we're going to see is that inflation is going to be higher than interest rates on average for a prolonged period of time. Now, you could get a deflationary shock like you had in 2020. You can get these brief moments where that's not true, but I think in general, we've already been in a period where inflation's above interest rates, and I think that's going to continue for quite a while.
And what are you predicting with interest rates? I know that's difficult, but the UK, where what was it, 9%? It's predicted to go up to 10%. The US is 8.3, I think. Eurozone was 8.1 today, I think. I mean, they're all around about that. Do you think these will settle down at like 5, 6%? Do you think we could go up to 12 to 15? I know there's real world figures, but we can only really benchmark what we actually know. Do you think we could stay around 8% and it could be for years? Like,
This partially depends on human decisions, which is what makes it challenging, right?
Okay.
So that giving an answer to that partially depends on what is Putin going to do,
Yes.
what's Europe going to do in response to Putin, what's the U.S. going to do. So in general, I think we're, say, in the U.S. potentially reaching a plateau for a period of time, where due to base effects you can kind of level off a little bit, but I think the underlying problem is still unresolved. That there's just not enough energy and certain commodities available, and Europe's got it the worst, but it's global because commodities are a global market. And so my expectation is that if you look back at the 40s and the 70s, you had very high inflation, but it wasn't a straight line. You had periods of pushback.
Okay.
And so I think right now we're kind of in a period of pushback. And it's challenging to say how successful it's going to be because it partially depends on understanding the breaking point when people riot, understanding, is it going to be any sort of de-escalation in this war or no? So those are variables that can influence it. So in general, I am positioned towards an inflationary outcome without trying to predict exactly what level inflation is going to be, especially because, as you pointed out, there's real numbers. There's different pockets of inflation. So I think that looking back at the end of this decade, energy prices are going to be much higher in dollar, euro, pound, yen terms than they are right now. But I think it's not going to be a straight line.
And I think it was a few shows ago. You said to me you think the story of the next decade is inflation. So it's clearly not going to be a short term solution. But I assume at some point when things start to level off, it will become a good time to start investing in certain areas. Like you as an investor, you know, what kind of time horizon, what kind of things are you looking at? It's important to have some dry powder ready.
Yeah, so I'm rather defensive as central banks are trying to push back a little bit. They're trying to suck liquidity out of the
Hmm.
market. But I'm still majority of my assets are in these long-term hard assets, things like energy producers, pipelines, profitable companies producing real things, Bitcoin, some gold, different types of commodity exposures, basically real world exposures, real estate. Um, and so basically my approach is to have this kind of diversified set of real assets as well as some cash for liquidity to rebalance into any sort of liquidity shocks we get, things like that, kind of take advantage of that counter-cyclical approach. So when people buy high and sell low, I try to just tweak it a little bit and do the opposite, but I'm not like I'm not actively trading the market too aggressively, just kind of a small dial that I kind of lean in when things get a little cheaper, and I kind of back off a little bit when things get a little bit euphoric.
But those hard assets, property, gold, Bitcoin, but also energy companies, because I think based on everything you said, you're assuming there's going to be some significant investment in energy production somewhere.
We're seeing it to some extent. I mean, we're
Okay.
seeing we're seeing more interest in the space, but I think a lot of the market is still thinking this is transitory,
Mhm.
and they're also concerned about the what percentage of the profits they'll be able to keep and things like that. And so we're not seeing this massive ramp up in capex. We are seeing an interest in capex, and then ironically, some of the supply chain things can feed into that. I mean, some of the materials they need to do energy capex are actually held up from logistics problems.